that's how you get a hold of me. If it becomes necessary, I'm more than happy to do office hours like I've done in the other classes. My experience has been that when I've done office hours in the last couple of terms, I haven't had that much participation. I think those who have participated have enjoyed it. I can make myself available to the extent that people are going to take advantage of it. I don't foresee having a need for it right now, but I like to use Google Hangout. I can also use Skype, okay? Those of you who are new in the class, what I would appreciate is if you leave me on a sheet of paper your non-NOVA email address. Just because my experience has been when I send Google Hangout invites and we need to speak, they don't always get through on NOVA. Sometimes they, I don't know, the spam filter picks it up or whatever. So if you've got a Gmail or a Hotmail or whatever, just let me know and I'll get that to you. I try to respond as quickly as I can. Some days I can respond the same day. Some days it takes me a day. You'll rarely go more than a day without hearing from me. We're here to learn. Above all else, we're here to learn. I know grades are important to us. I know we like to feel validation over, hey, I got a 4.0 or I got whatever. No one's going to ask you what your GPA is in graduate school. What people are going to want to know is what you learned and who you interacted with and who you met and the relationships that you developed. So take advantage. I mean, Glenn, I think, made a good summary to that point. You're paying good money for the program. Take advantage of it. You get out of the program what you put into it. If you come in and phone it in, you smile, you're nice to your instructors, you get by. If you work hard, you learn, and you're going to see a big difference in your job. You put an effort in and meet people in the industry, you might get a good job, okay? So you get out of it what you put into it. So my encouragement to all of you is to take advantage of the opportunity, okay? Learning isn't easy. I remind the kids at school, they use football all the time. To develop expertise, to develop, the mastery of a particular, task requires hard work. It's never easy, right? If things were easy, then everybody could do them. Then they wouldn't, by definition, So, in order to learn, we need to make a little bit of a sacrifice. We got to read, right? We got to listen. We have to apply what it is that we have. At times, learning is repetition. It's repetition, it's repetition, it's repetition, okay? So I don't like to teach by rote, but sometimes when we do something over and we make a mistake and somebody points it out, and we do it again and somebody points it out, that's how we learn. It may seem like a cumbersome or painful task, but in order to learn, there needs to be a little bit of sacrifice or pain along the way in practice, okay? You will find that this class is not overly quantitative. More than anything else, what I ultimately would like for you to have is a set of tools that you can utilize when you're faced with a situation. I spoke with the students over here before. I've got a couple of checklists that I will leave you with at the end of the term. Because what I don't want is to try to memorize a checklist as we're going through the term. What I'd like you to understand is, as Glenn pointed out earlier, if we're going to acquire an asset, what do we need to be concerned about in order to not make a mistake, right? Or lose money? So try to understand, again, going back to the football analogy, if I tell the players all the time, because I've gotten to the point, I know what all our players' responsibilities are on all of our different plays. And if I go through the plays and I go through all of the different formations we can run them through, I've probably got a couple hundred different combinations. And I've got 11 players on the field. So you ask me, how do you memorize all those combinations? And the reality is, I don't. I understand the flow of the play, and I understand what we're trying to do. If it's a trap, we're trying to influence somebody. So I can generally point to who needs to go where. And that's the same thing in life. If ultimately, you want to buy an asset, right? Well, what should we be concerned about? Where could we lose money? What do we need to validate, right? Where might there be a risk, right? Because I can give you a checklist today that may work great for a little strip shopping center. But if you come across a hotel and now not only you have a piece of real estate, but you also have an operating business, then you need a different checklist, because now you need a a checklist for an operating business, right? But you can start with the checklist that I'll leave you at the end, right? But really more than anything is to say, okay, so, okay, that hotel has a business on it, so it's got a restaurant, okay, so, you know, what do I need to take a look at, right? So, you know, am I concerned with inventories? Am I concerned with receivables? Probably not. Am I concerned with internal controls there? Am I concerned with HR matters, you know, and things like that? You know, for example, the whole realm of human resources is one that we don't touch that much when we look at assets in real estate. Because we're purchasing assets, not operating businesses, right? And we tend to outsource the management to somebody else, right? And so, you know, all of a sudden you're tasked with a self-storage facility where you've got employees, or a hotel where you've got employees. Now you've got a whole other component. But if you take the tools that we lay out here and you think critically about what you're trying to accomplish, you know, really you've learned. Hopefully you've learned, and hopefully you've taken something out of this class, and that's what my objective would be for all of you. So, you know, let's take a look at, you know, where can we find, what are the things that we need to identify, and how do we move forward? So ultimately, what are we trying to look at, right? How do we analyze the information to make informed decisions about acquisitions, okay, and investments that we make? You know, we're talking about components, principles, and standards that are utilized by different players in the industry, because, you know, Claudia was sitting here as a lender today, and as she mentioned to you during the presentation, she's going to look at an environmental assessment, and she's going to look at an appraisal in a totally different light than you are, right? And so different players in the industry have a different focus. We'll have a buy-side focus in this class, but we can also have a sell-side focus. You know, one of the things that, you know, you always need to be cognizant of when you own an asset is that there's going to be a day you're going to sell it, right? And if you realize the pain that's involved in the investigation to acquire it, stop to think that when it's your time to sell it, to the extent that you've got good records, that you've got updated structural studies, that you've got, you know, you followed a form lease that people could follow, and you've got lease abstracts already prepared for them, right? That you've got updated, you know, phase 1 or phase 2 environmental data, right? So to the extent that you can ultimately keep information handy that will help you to establish a data room in order to sell a building easily, or allow people to understand it easily, more easily, so that they perhaps would provide a higher value to you, then you can take a look at this class as something that's helpful from the sell side as well. Because stop to think, the seller needs to make the buyer comfortable. And while the buyer may have specific information that they want, for the most part, in commercial real estate transactions, most buyers are going to want most things. And to the extent that you can facilitate that process, the quicker the transaction's going to go, and hopefully the higher the value that you'll be able to obtain for it. This is the first time I teach this class. I know it's been taught before. I actually have the material from the previous instructor, so I've used some of that, and I'll continue to use some of that, but I want the class to flow to some extent based upon the particular interests that you may have, right? So, you know, Nicole asked me why my book wasn't so thick yet. You know, I always bring a thick book, and now it's only because it's thin, because it's only one session, right? This is only one session. Okay, so you know, I've got the opportunity still to, you know, tailor the class to some extent. So, you know, if you feel that there are specific topics that we're covering today in the overview that we've done, or as we move forward, I'm happy to expand or lay back a little bit. I will tell you this. There are certain areas that are outside my personal level of expertise. I'm not an attorney, as you guys know. I'm a CPA. I'll tell you about who I am in a second. Most of you already heard it. But so you're likely to see more operational and financial focus in this class. The instructor who taught it before was an attorney, and his focus was a lot more legal, right? My view is the following. There are experts in their areas, in their chosen fields. Rely on them. So we'll go over titles, we'll go over surveys, we'll go over environmental. I've got some samples to go over with you. But ultimately, I think that as real estate operators, we need to rely on the expertise that others have. we should know what we know and know what we don't know. And so, you know, I would never attempt to, you know, get comfortable with title on a real estate transaction without sitting with my attorney and having them do the work and summarize what they think we need to do. For example, it would be beyond my level of comprehension to really analyze a very complex phase 2 environmental and try to make sense of what I need to do and what the economic impacts of that are without sitting down with a consultant that I trust, that I know speaks my language, right? So, you know, my focus in this class to some extent is going to be more operational, financial, and my encouragement is going to be when we talk, you know, cover some of the topics where you're going to use third-party consultants to understand the basics, but also rely on their expertise and level of knowledge. Yes, Robert.
How do you balance out the need to have expertise and the need to keep costs down?
I mean, I told you before, I think, what's the old saying, it takes money to make money, right? I mean, my perspective has been, and I'm not one that likes to, there's an old joke, I won't go through the whole joke, but you know, the punchline is something like a consultant's a guy who comes when you don't invite him, and he tells you what you already know, and then you gotta pay him a lot of money. Something like that, right? So I'm not one for hiring consultants, but you also have to know, as a developer, you can't master all of the different disciplines that you need to have, right? Because at the end of the day, you can really be a totally turnkey operation that goes from, you know, site identification to, with your own in-house attorneys and planners and designers, go through a whole, you know, rezoning and entitlement and platting, and you can have your own in-house architects that design things, right? And your own estimating and construction group that builds it, and brokerage operation that leases it or sells it, right? You can have a financial arm that obtains the money to finance it, and real estate developers tend to integrate some of those functions, but it becomes almost impossible to integrate all of those functions. So what do you integrate? Well, you integrate the ones that you've got competencies over, and you outsource the ones that you don't. Or where you've got critical mass, right, that there's sufficient work to justify. Why did Cadena, the firm I work for, have a construction company? Because we were doing enough work that it compensated having an in-house firm that functioned as a construction manager. We didn't self-perform. You know, we were construction managers, but we were the GCs on the job, and we found a small revenue niche to the extent that we had third parties involved, but more importantly, we had tighter control. But there was sufficient critical mass to justify it, right? On the front end side, we had 2 or 3 guys that focused on planning and zoning and entitlement, but they really were the liaisons with the third party. So they were guys, one guy was an ex-city manager who would come out of a planning and zoning department, who had incredible expertise and knowledge, but really ultimately relied on the third-party consultants, the attorneys that we used to shepherd things through. We had in-house counsel, but we didn't endeavor to do all of the leases on all, you know, we had thousands of leases. So we didn't endeavor to have in-house counsel handle all of our leases. We used a third party. In-house, we approved the form, and we would approve through legal changes to the form lease. But we didn't endeavor to try to do everything in-house. Now, maybe some organizations feel comfortable doing that, getting a couple paralegals in-house and doing it. So, you know, ultimately, when you go back to, those are personal questions you need to ask, but you need to make an investment in order to realize a return. So somewhere along the way, you need to make money. You know, we talked about the abstracts earlier today. You know, I never felt comfortable in the context of our business that I had dedicated personnel. We didn't have an acquisitions department. So whenever we bought something, I pulled from different resources. So I never felt comfortable that I had enough resources to justify, you know, saving the money, but incurring the risk that maybe we'd miss something, right? There's other places that have acquisition department, and you know what? They've got people that are reading leases all the time, and they feel comfortable doing that. So there's no hard, fast answer to that. you know, you just need to figure out what makes sense for you and for a particular situation. Make sense?
Yeah.
Textbooks, there's no textbooks. It's good, right?
I don't know.
No. So, you know, I wrote the journal. Read the Sun Sentinel. You know, I read, it was shocking. It was absolutely shocking. This week, the Miami Herald published their, you know, ownership notice that they have to do once a year. And I remember when the Sunday Herald in Miami had a circulation of 600,000, and the weekly was almost 400. The daily was almost 400,000. You know what the daily circulation of the Miami Herald is today?
A lot less.
92,000. And it doesn't hit 200 on Sundays. So people aren't reading, but at least they're not reading printed editions. So, you know, everybody's got, you know, all these publishers are trying to figure stuff out, but the point is not to worry about the publishing business. The point is to read, right? Alex is, I mean, he inundates me with junk, you know, but I love it. You know, I told you, I get all these briefs, you know, these I sent you guys to smartbrief.com. Go to those of you who are new in the class, smartbrief.com, and they put out, it's a service out of DC that puts out a couple hundred different briefs for different industries. So, you know, I get some that are focused on CPAs, I get some that are focused on capital markets. They do one for NAREIT, so I get one on REIT. They do one for ICSE, so they do, you know, retail. So, and they'll have different frequencies, but I get all that. I get Florida Trend daily. You know, Florida Trend does a daily morning and afternoon download from all the major dailies in the state. You know, the Economist update. You know, and on and on. You can never have too much information because knowledge, information is power. At the end of the day, it's power. So if we don't know what's going on around us, it's difficult for us to make informed decisions. So I encourage the journal because it gives us a good macroeconomic view. And I encourage your local newspaper and any industry related. Globe Street is another great little daily real estate one, you know. So, and all these, you know, guys have them. So whatever you're interested in, you need to know how to use a calculator. I use a 12C. I think, Fred, you use a TI?
No, 10D.
Okay, but that's not the reverse Polish one, right?
Correct.
Okay, so I'll teach you the reverse Polish if you don't know it, if we need to use it, and Fred will show you the regular one if you need to. But we don't, it's not an overly quantitative class, so I wouldn't worry about it. Just have a calculator handy because, as you've seen, when I say, hey, what does that mean? And, you know, I ask you guys, so figure it out. And then MS Office, because you might have to make some presentations in here. Grades. Okay, I mean, this is all in the syllabus, you know. So you got to show up, you get some credits for showing up and for participating. You're going to have some group and individual assignments, and we're going to have little quizzes at the end of every class, just like we do in the accounting class. So pay attention. Pay attention during class. Alyssa's eyes went like, woo! You will have a test today. And you will make group presentations today that you will be graded on. Yeah. Surprise, surprise. We still have 4 hours, you know, in a day. So, sounds like fun. Let's get right to it. So, if this adds up right, so if you show up, oh look, it's not a 10 Devons. Okay, so if you show up, I know what happened is I copied that from an Excel spreadsheet that didn't have spell checker. 5%. Your peers will evaluate you at the end of the term. You'll be working in different groups every session. So make sure you carry your weight, and it won't be based on one day, but you'll work with people, you know, throughout the term. So it'll be a small, you know, small bit. If you get like a really bad grade from a lot of people, it might count more, okay? So subject to extra weighting, subjective in the event of negative evaluations. Just, you know, pull your weight. You know, I'll make easy groups today, especially for the new guys. You know, since you're new in the program and don't have that much experience. The in-class work, 25%, take home, 25%, and the end of class quiz is 40%. Okay, and you know, like I did last term, if we got to modify it to help you, I'll modify it. You know, we threw out some exams last time and all that. I'm not here to use grades as an obstacle to your learning. It's just part of the measurement of whether, you know, we're learning or not.
WSJ falls under the take-homes?
We're not doing that this term. Unless you'd like me to.
No, that's okay, that's okay.
I can give them.
I'm
Some
good.
people like them.
I don't like the
use
5 minute
Wall
one.
Street,
I don't
you
like
see
to
them.
ask the one.
They-
The 5 minute
and you can make your own. So it's a great little,
We
you know.
definitely don't like the 5 minute one.
Well, right, but, okay, so, hold on. Okay, so, I send you a link to an article. You have unlimited time, and you can take the question and go back to the article to find the answer.
That's the one.
Well, you didn't read the article. You didn't read the article. That if I send you, if you have a time limit, you either know it or you didn't. You read it or you didn't.
No, but 5 minutes for 10 questions? It goes fast.
No, it's because you were trying to go back and reference the article that you hadn't read in the first place. Okay, you got to show up to class, okay, if I give you reading or other assignments, okay? And you will have assignments. They need to be, you know, turned in and completed before. We talked about the electronics in class. Open and participative environment. Questions are relevant. Without questions, it becomes a monologue, okay? So part of the learning process is, please clarify that. Can you talk a little bit more about that? Hey, what do you think about this, okay? So ask. And we need to encourage everyone else, right, to, oh, I thought I had it there. Like, okay, I guess I had something about like being respectful and, you know, tolerant of your fellow students, and, you know, don't say that's a dumb question or why'd you ask. I mean, you guys have been pretty good about that, but I felt the need to say that, okay? So we'll have some individual case studies, and we'll have some group in-class assignments, and we'll go through that in a second, okay? And some individuals, what you will not have an individual case study for the next class, but you will have for the subsequent one. So I'll introduce a material in the next class. You'll have a take-home case study, and it'll be submitted by 3 o'clock on Tuesday prior to the next class session, to the third class session, so that I have time to grade it, okay? Quizzes, you know, they're easy. It'll be the last hour of the weekend, okay? And you know, if you listen, if you prepared, you should get 100. Okay? I've said that before, haven't I, Nicole? I don't know that there's going to be an opportunity to plagiarize work, but you are going to have some individual take-home work. I, again, last term, unfortunately, had problems with plagiarism. And I take that matter seriously. It doesn't matter to me that you find someone else's work. In fact, the way that the last class was structured in a way to allow you to take other individuals' research and propose your own interpretation or analysis of that. So I understand in the context of this class, we really don't have the time to do our own research. But when we use somebody else's research, we need to recognize that. And cutting and pasting somebody else's words and not giving them credit not only demonstrates that we haven't researched or, you know, provided any critical thinking, it also is something called plagiarism, which is stealing someone else's work, among other things, okay? So the syllabus goes into that. I feel the need, it ultimately, at the end of the day, it shortcuts the learning process for you all. Because I can tell you, everyone who tries and works hard and gives an effort is going to pass the class. The only people that have never passed my class, the classes I've taught here, have been people who want to shortcut the learning process. So I just want to say that for some reason it always happens, and I don't want it to happen again. Please, just use your own thinking. I don't care if you get the answer wrong, but you try. That's worth a heck of a lot more than cutting and pasting something out of Wikipedia. On top of that, find something that's not Wikipedia that's harder for me to find. Okay, and you know, we can work together and all that, but if we have a quiz or whatever, if you're doing your individual assignment and have a question, send me your email and I'll respond to it, okay? I'm here to help you learn. That's part of the process. It's about learning, that's why we're here. Okay, that's the course overview. Are you satisfied?
I am.
Are there any questions that you have?
Nice.
Okay. Does anyone else have any questions?
Will you give something to us with like dates and deadlines and stuff like that for assignments?
The No, it's not that. It's not, no, it's not. No. The take-home assignments that you will have will be, they'll be assigned in one class. I'll be do the next. So
Tuesday before the next.
yeah, so you'll have 10 days to work on it. Okay. Yes, Rob. Dustin.
If it's possible, can you return the work that we submit to you so we can see what we did wrong?
I'm happy to bring the work that you've done as I have and shown it to other students.
But it's like impossible to read your markups. That was the one thing that I was thinking, it helps me to learn knowing
Right.
like what I did wrong or how to.
What I can do, and I usually say, quite a bit after class, I'm happy, if you don't understand my hieroglyphics, I'm happy, to sit down and explain what I think, you could have done, okay? I don't always, I think those were your presentations. Typically the exams I grade on the computer, and so I type my answers, but then I don't, print them all, okay?
But if we ask, we can
I'm
get
more than
access to
happy.
them.
I'm more than happy to give you the feedback on what may have been lacking or what you may have missed. I mean, I think also we didn't do it with the final in the cap markets class, but I did spend an hour and a half going over the suggested answers to the first midterm.
Right.
So I did go through that, and I'm happy to help close the learning process on that. Okay. Anything else? Okay. For the sake of time, what I wanted to show you, when you asked earlier on what one of these books looks like, right? So a couple of years ago, about 3 or 4 years ago, I came upon a building in I came upon a building in a sub-market called Gateway, which is right across Tampa Bay from West Shore. West Shore is the largest. Guys should know these things, so we need to know our states and we need to know our markets. West Shore is the single largest office sub-market in the state of Florida. So there's a downtown, there is a central business district office market in Tampa. But the largest market is West Shore. Generally, West Shore is just south of Hillsborough International Airport, the Tampa International Airport. Okay? So this happens to be right across the bay from that. It was interesting enough for me, even though I don't work that much professionally, I brought it up to some friends. They thought they wanted to buy it, and I put together a book for them. They didn't really have the resources, they had capital, they didn't have the resources. So I wanted to use that as an example. So the question that was asked earlier, this was owned by Teachers, which is a large, money management, pension fund. They co-owned it with a developer of a master use, park there that had, multiple different uses. They'd owned it for a while. It was 80-some-odd%, well, they said 100% leased. It wasn't really 100% leased by the time I looked at it, but they wanted to market it. They hired Holiday Finoglio, HFF, who's a large intermediary in the real estate markets. It's a publicly traded limited partnership. They have an office here in Miami. One of the principal partners for the country actually runs the southeast out of this office. But I thought it was interesting. I took a look at it. They'll put this book together. They'll put a book very similar to this for an asset. I get these things every day in the mail, okay? But So confidentiality, they'll tell you that they don't really represent anything that they're giving you there, even though they're giving it to you, okay? They'll give you some images of, you know, the asset. They'll give you some exterior shots. They'll give you some interior shots. They'll give you some overall highlights, right? So they're going to tell you very quickly, how big's the building, where is it, what's the occupancy, what's the parking ratio, what's the floor plate, right? How old is it, who are the major tenants? They're going to lead you to a value. At the end of the day, they will do the same thing that an appraiser would do. They'll do the same thing that you'll do as a buyer. They ultimately are going to run an Argus model, and they are going to tell the seller what they think that building is worth. That Argus model will typically serve as the basis for you to then do your own model. Okay, they'll usually make that available, but then you'll have to validate or adjust or modify or do sensitivity analysis on the different variables. We'll work on that component in the third session. Okay, but just so you get a sense, they're going to essentially, as a marketing agent, do a diligence on the asset and put together a book for you. Okay, they're giving you a lot of information already. Okay, who else is in the submarket? How many buildings? How many square feet? What's the average rent? Right? They'll give you a bigger overview. You can see on the other side of Tampa Bay, you've got the airport, and that's where West Shore is. Okay, actual site plan. A little bit more information on the asset, right? They'll have a stacking plan at some point. Like typical floor plate, interior, they'll give you a stacking plan. This is very common, right? Ultimately, whether you do it in an Excel spreadsheet, whether you do it in a Word document, it's a visual manner in which individuals can see who's in the building and what they occupy. These people took an exterior shot and sort of laid it out. I've seen people use an Excel spreadsheet and build it up. I've seen people do an Excel spreadsheet and kind of look down. So a lot of different ways to look at it. But ultimately, it's a tool that people use, and you'll put it together in your own internal investment memorandums. I'll show you another one in a second on how it is that the building lays out. Okay, tell you a little about the tenants. We talked in the accounting class, and we'll talk about it a little bit in this class, the importance of the credit associated with a tenancy. And we'll review that. We won't spend that much time on it in this class, but ultimately, if the asset is worth the net present value of its cash flows, right, the certainty of that cash flow is important. So, and one of the things that sort of, you look at the economics of a deal like this, you know, you're looking at the time, what were highly rated credit tenants whose publicly issued debt was trading for about a 4% return. But you could buy the building that they were in, which essentially was their credit, and yield like an 8% cash-on-cash return. So, you know, again, the power of leverage with real estate. Rent roll. So the rent roll is a document which lays out for us all the particulars, tenant by tenant, space they occupy, right? Rent they pay, right? Any particulars related to reimbursements, expansions, or other right that they may have. So a rent roll can be produced from lease abstracts, for example. I mean, typically the rent roll is I'm going to call it a legal document because to some extent you will ultimately make representations about this document. It is the summary or the input for your revenue system within a property management function. This system, this rent roll, will ultimately feed your billing and your revenue generation within the operations of your real estate. Any questions on that? You guys seen rent rolls before?
No.
No? Okay. Fred, do we touch that anywhere else in the program? Not really? Okay. Well, I can bring some more examples in and spend more time. I didn't want to, because I just want to give you an overview right now, okay? But ultimately, there's only 5 tenants here. So it's a small document. You know, you've seen rent rolls that are, you know, this thick with, you know, buildings with, or parks that have hundreds of tenants, okay? But ultimately, it's what flows into your revenue generator, right? Whether you invoice these guys every month or you create a receivable that you can track, however it is that you do it. And that's what that a marketing book that somebody sells puts together, right? They'll give you a market overview, they'll give you nice glossy pictures, they'll give you a financial summary. In some cases, they'll actually do a pro forma and put it there. In other cases, they'll send you the pro forma separate. Typically, they'll send you this, they'll send you a teaser piece. You got a PDF, hey, so-and-so's coming in the market. Then you get another saying, it's in the market. And you typically will sign on, like with HFF, I'm signed on with them. I could just go in, sign in for a particular deal. They'll give me access to their electronic data room. There I can pull down the entire document. I can pull down lease abstracts. I can pull down the Argus file. I can pull down structural studies they may have, environmental studies they may have, etc. So I can already begin to do diligence without even spending $1. And that's what I did in this particular case. So in this particular case, I was like, okay, I don't have any money. I'm not going to spend any money. But I want to show these guys that it might be worthwhile to spend money on this. So I put together, I think this is the one. I think this is the one. Yep. Okay, so I put this together. And I did this without spending any money, going back to, okay, with the information that I had available to me, what could I put together? What did I think this building was worth, right? So, what I like, this is my personal format that I use. I like to put everything on one page. So this is the same summary document that I would use when I worked at Flagler to at least get a go-ahead from an investment committee to pursue something. It wasn't necessarily the full book that we put together, and it wasn't the full book that we put together when we were underwriting development. We were underwriting development, we took a different route. But we're going to acquire an existing stabilized asset, and basically, I wanted people in one page to see what they had in front of them. What were the key points for me? Overview, right? What's the occupancy? What's the yield? What's my IR? Levered and unlevered, okay? I'm telling them what my cap is, what I'm assuming the cap is. What's in place? Where's the market? Who are the major tenants? And going back to the point we spoke about before, rollover. So, remember, that rollover is either an opportunity to increase the in-place rents if the markets are going well, right? If the leases have been in place for a long time. Although in a down market, it potentially works against you, okay? So, you look at a building like this right away, and I'm saying, okay, I'm coming in at 8, I'm paying $23 million, I'm paying $190 a square foot. I can already start drawing comparisons to what's replacement cost, right? Where's the market for Class A suburban in the state of Florida, right? Prototypical suburban office building, 5 floors, 25,000 square foot floor plates, right? What am I going to get when I'm out of this thing, right? So I look at this, I don't really have a lot of opportunities to mark up. It looks like rents are already in market. So this is not much of a value play. It may be a positive financial leverage play, right? I can lever it and get a higher return, but listen, I'm pretty comfortable there. I got 4 tenants, they're all recognizable names, they're all credit, and I don't have to worry about leases. This was back in 2011, right? I don't have to worry about any potential impact to my cash flow. I can make it bigger. I don't have any potential cash flow, impact to my cash flow. Till 2017. Okay, now I analyze that further in depth later on, but I'm telling somebody in one page, right? I'm going to talk to them about the market, okay, about the building, about the tenant base, and I'm going to talk about financing issues, okay? In this particular case, there's no assumable debt. There may be, and I would put some money in there, But with conversations with lenders, this is what I think we could do, and that's what I've underwritten, okay? The intermediary's telling me the building's gonna go here, that's where they've indicated to the seller that they're gonna get bids at, right? And the most recent replacement cost was $250. So, in one page, I've told somebody, here's the deal, okay? I've addressed the cash flow, I've addressed credit, I've addressed the market, and then I use free stuff. I didn't fly, where can I get this stuff? I, get marketing brochures on the internet. I got aerials, these come from CoStar. Get a site plan, building images, inside, outside, use a stacking plan, boom. So what do? I used to have access to CoStar. We're going to work with that a little bit later today, okay? But I start honing in on, okay, what does the Tampa market look like? I don't live in Tampa. I don't have these numbers off the top of my head, right? So I got to go get information. What's the Class A market? What's CBD? What's suburban? What's B? What's C? And then let's take a look at the specific submarkets within Tampa, right? So, I'm in Pinellas County. What does Pinellas County look like? What does Gateway submarket look like? Sure enough, as the marketing material said, CoStar reports the same thing. 24 buildings, 3 million square feet. Quoted rates, 21 bucks. Now I got a problem, I'm at 24 bucks. I'm at 24, and the market's at 21. If any one of these leases goes out, I've got an impact on my cash flow. Okay? Or I got to get over the fact that my building is better than the market. Right? It always is, right? Isn't that the way it is? Now, what's important? What's total inventory in my submarket? What's the overall vacancy, right? Because that's the other thing. There's a building with 4 tenants and it's occupied. Now, assume the building was 50% leased, right? Now, I'm going to lease it, right? Because I'm good and I'm going to get a better marketing agent, right? And that's where my play in buying this building is I'm paying today's cash flow, but I can get tomorrow's at a higher. But the question that I ask, how do we get beyond where the market is, right? Because every model I've ever seen gets occupancy up to 98%. But if you're in a submarket where vacancy's 15, 16, 17%, why am I so much better than the market, right? Those are all, sort of questions, to ask, right? Hone in within the 24 buildings that are in my submarket, right? What are the buildings? How much is available? What are the asking rates, right? What's their age? What's the parking ratio? So, Tampa, Class A, B, and C, submarket. Now I'm digging into my specific competitive properties, right? So, what do those properties look like, right? And then I start looking at those properties. So, start looking at those properties, right? What do they look like? I always like to do, I'm going to make it a little bit smaller. Everyone has their way of looking at it. I like to look at 2-3 year direction on rates and occupancy. Because ultimately, we said real estate is a supply and demand market, right? Yeah. So, to some extent, vacancy should drive rates, or the other way around. Occupancy should drive rates, right? The more demand, the higher the rate, right? That's what entry-level economics told us, right, in college. So, our direct vacancy shoots up, but it's, from 7% up to 12, down to 10. Rents actually went up to $27, right? I mean, the problem is the scale of this particular chart, right? Because I've got dollars with percentages here, right? But you do see from $21, vacancy shoots up, rates go up, right? And then vacancy starts coming down and rates start coming down, right? And I start looking at absorption. Remember the years, 2007, 8, 9, 10, these weren't great years, right? And then also what's important is how much more supply is coming online. So what are the demand and supply drivers in a market? So what's the direction? What's the tendency of where market rates are? And why am I honing in so much on this? Because that's a project we're going to work on in a little bit right now. Because rents are where your models start in diligence. And validating the market and understanding the market is probably the most important one of the features that you can get your hands around, or tasks that you need to get your hands around in a diligence project. Because that's the revenue, that's the number, I keep saying, that everything else gets subtracted from. If you cannot figure out, if you cannot get comfortable about, the rents that you're going to get, everything else, isn't that important. You got to start with the most important number. Large transactions in a particular market, so kind of the scale of what's happening, what building are they going to the extent that you can get rates, you get rates, right? Sales comps. So we're going to hire an appraiser, typically, but we don't need to get an appraiser right out of the box, right? CoStar will give us that information. So, I already start triangulating. These were two very similar buildings, right? In similar submarkets. Who's the buyer, who's the seller? And they're pointing me to $195 a square foot. So, if the seller's looking from 180 to 190, I think at an 8.1 cap rate, I could pay 189. And I got a market that's substantiating, and now I'm starting to triangulate to an area where I feel pretty comfortable, right? Here's the rent roll. I took that information and just, color coded it by clients, right? But again, what percentage do they occupy, right? What are the rents? When do the bumps come up, okay? And any specific other, questions that they may have. This particular one I took from Argus, if I'm not mistaken. So I like to show my lease roll in this type format. So years. So you can see 2017, those are my critical years to cash flow here, right? So this is a graphic of when my leases expired. And going back to the conversation we had this morning when Glenn brought it up, is this is your opportunity to increase or your risk if you can't release the space in these particular times, okay? And there's no hard and true answers. There are, no guidebooks that you could go to. Ultimately, you need to understand your cash flow requirements, you need to understand your risk tolerance, and you need to understand your portfolio. One of the things that I always tried to do is, when we looked at leases in the context of a 110 building portfolio that we had at Flagler, we understood that we had multiple cash streams, right? So, for example, a development undertaking had less risk if we were putting 120,000 square feet of supply into a 12 million square foot portfolio. Because we could afford to have that 1% of vacancy without it significantly impacting us. Right? Or could we do, could we take a look at a building that was a 200,000 square foot building that had a huge expiration next year, knowing that we still had 12 million square feet of cash flow there? Yes. Now, I'm buying one building. It has a tenant that expires next year. We bought such a building. We bought a building in Del Rey. It had a division of IBM as a tenant. Their lease was up in a year. We didn't know if they were going to blow out or not. The local manager was telling us that they thought they were not going to stay. They thought they were going to get transferred to Tampa. That was until Atlanta. If that was your only building, is that a risk that you can afford to take? Right? And in that case, what happened? We bought the building, and IBM blew out, and 3 years later, it's still vacant. So, if that was your only building, and you didn't have the wherewithal to sustain it, you're gone. You need to understand where this rollover plays in relation to your own cash flow requirements, okay, or your portfolio's requirements. Make sense? This is straight out of Argus, okay? So our revenues, our expenses, our NOI, our CapEx, okay? And this is the cash flow. Here are the major assumptions that we're using. We'll go into detail on all of these different areas. Today I want to talk about this one, market rents, okay? So, in this particular case, we distinguished between larger spaces and smaller spaces to try to get to what different assumptions would be on how long space would be dark, what were the probabilities of renewal, what were the market rates, what were the TIs, what were the leasing commissions, etc. Okay? These are the operating expenses, and as we spoke earlier today, we can validate these through review of audited statements, we can validate these through analysis of current year statements, we can recalculate or recast some of the major items like real estate taxes and insurance based upon our specific conditions or the conditions of the transaction or what our ability to procure services. I'll get to that, Michael, where we may be able to renegotiate some of these operating service contracts, and ultimately we can validate this with BOMA, compared to other, typical or similar properties in the market. Yes, Michael?
For the most part, are you always basing it on price per square foot, or are you seeing it as a whole number?
I always like to work at price per square foot. It could be possible that in certain asset classes you may work per door or per unit. Yeah, you may work on a per unit. But I always like to reduce things to, I get my hands around that.
And that's on a gross leasable area you would see that on operating expenses?
I'm sorry?
On the gross, on the total amount, that's what you would see each price per square foot, or what you're actually...
Right. I mean, the total expenses, right, divided by the gross, leasable square footage.
You're just taking that out to $24 and...
That's correct. That's correct. Now, remember, and I don't remember in this particular building, but remember, you got to understand every building has different leases and every market is different. You may have net leases or net of electric or net of janitorial or net of electric and janitorial in an office market, and you may also have fully gross leases. So you just need to understand, because that's what I said before, in the long run you want to operate the most efficient asset that you can operate. But efficiency, if you come in and buy an asset and reduce operating expenses depending on the lease structure, it may not drop into your bottom line directly. That may just be savings that you pass on to your tenant. In the long run, if you're on an efficient building, more tenants will want to come to you. If you can offer, if you're in a totally net environment and your building costs $9 and all the other buildings cost $11, you got a $2 gross advantage over the market, right? Or on par, you can get $2 more net and not be out of the market. Right? I hadn't done a site visit. I just did some IRR calculations here. I took the cash flow, right? Assumed the purchase price. I levered it. And then I did some sensitivity analysis, right? Different cap rates. What does that do to my purchase price? What does that do to my IRRs, levered and unlevered? What does it do to the cost per square footage, right? I went and did an impact on interest rates. So what if my debt costs me a little bit more, right? Impact of leverage. What if I get a higher leverage? So I assumed 50%, 2011, at 450 fixed, right? That's what was giving me a 13.6%. But obviously, if you can increase the leverage, look how the IRR increased significantly, right? All other factors being equal, if you lowered, and these are single dimensional tables, I could have done both, right? So play with the leverage and play with the rate. And the impact of cap rates, right? So I assume the higher cap rate going out than going in, obviously to the extent that I would have had a favorable movement in cap rates, further compression, it would have increased the IRR. So again, this was a for free day and a half, 2-day analysis based on publicly available information. I was able to take these guys and say, okay, do you want to pursue this or not? Okay, so you can do a lot of work. I mean, I feel pretty comfortable that for a couple of bucks and a couple of days after this, we can make a decision. So, that said, there's also, the other sort of aspect of that, Robert, is that there's a tremendous amount of comfort knowing who your seller is.
Mm-hmm.
Because if a large institution owns a building, they hopefully have managed it in a way that, your risk is going to be your credit risk and your cash flow risk, okay? I mean, that's, at the end of the day, you shouldn't have any operating risk in a building that's stabilized with 4 tenants, that's new, that you've done a structural study on, that has no environmental issues, right? I mean, what's the risk? I mean, this is like money coming in the door. This is printing money. Dustin.
Did they go through with it?
No, they didn't want to do it.
How come?
Because it was, it's more complicated. This was a teaser to raise a couple $100 million for a fund. So we took it to a guy who threatened to put $200 million into a multi-asset fund. And then he said to me, listen, he wanted to talk, it was a family office. He wanted to talk to the guy down in South America, and the guy said, we don't want to put money into a fund, we want to do deals one by one. So he said, bring me this deal, or a deal like this, off market, and I'll tell you if I want it or not. And back to the conversation that Glenn was having early this morning, I said, I've already gone out on the line and had these guys hold this for a couple of days. If I can't get clear decisions from you, whether you want to move forward, and in that case, you can't get off-market deals if you're asking for favors all the time, and then it's subject, right? So I said, listen, I don't work that way. I don't work that way. So they didn't move forward with it. This is the building that somebody else bid a couple $100,000 underneath what I was offering to do. It was put under contract, and when the Estoppels came in, this tenant complained about the parking of the hotel next door, and he eventually had to pull it off the market. It subsequently sold sometime later, a couple of years later. But I mean, that's always my sort of case study for real estate,
Wait, where did you calculate the cash flows, or where did you get them from?
Well, they gave me an Argus model. I used to have Argus at the time. My Argus license is gone now, but I used to have Argus. So they gave me an Argus model. So I used to have CoStar too. Well, my CoStar's gone too. So. But I'll get there. Okay, we'll crawl, as you'll see later today. I can crawl and beg, okay, and you can get whatever you want as long as you ask. Okay. Now, really quickly, I won't go into all of the detail, but Glenn sent me. I've got. Glenn, who you met earlier today, the fund Glenn works for bought 901 Ponds, which is a building in Coral Gables, and he's been kind enough, for educational purposes, to share all the documents surrounding that transaction with us. Now, we'll work on different pieces of it. We won't work on all of it, okay? But one of the things he showed me, or that he included, was his investment memo, and you can see. Different than what I put together, okay? Different style, different format. He's working for different people that are looking for different things. Look, when I worked for the people, when we sold Florida East Coast to the Fortress people, they wanted our investment analysis to have 3-year IRRs. And I said, you guys are nuts. I mean, how can you develop assets, within the context of a long-term portfolio, with 3-year lives? And the conversation extended to, we were doing a large 1031, we were buying a bunch of value-add buildings, and they wanted a 3-year turnaround, IRR. So we can't turn all the stuff around in 3 years. well, that's what we want. I go, well, then you can't get the returns that, because nothing comes for free. You want higher IRRs, there's got to be more risk, there's got to be more work. More work requires more time. So we can't buy 20 buildings, lease them all up, clean them up, and have them 100% leased and sold in 3 years. It doesn't happen. But they wanted to see 3-year IRRs. 7 to 10 is a little bit better. Okay, so but this is just, he's got his one-page summary. Okay, he's got his one-page summary. How he's getting the financing. He's got his map. He's got recent comps, right, to justify his case. What else is on the market, right? What's been recently developed? What's the occupancy? What are the rates? I mean, it's all very similar, right? Major leases that have happened in the market, right? What's the IRR that we're going to get, levered and unlevered? So, different way of presenting it. He does a SWOT analysis here. What are the strengths of the asset? I'm sure that his bosses asked him for this, right? That's the way they wanted to see it. So, different way of looking at it, but essentially the same information.
What were the adjustments on the price? Was that things that they found, like the cooling tower needed repairs, so they had to figure it out?
I think, we'll dig into this more. My understanding, if I recall correctly, was that they identified some items that they went back to the seller for, and either they were going to have to come out of pocket or there were adjustments made. So here's what typically happens on that, right? Let's take a look at it. I wasn't involved in this transaction, so I personally, I don't like to get into too much detail on other people's deals. But, so in his particular case they're paying $22.5, but there's all the CapEx they're going to have to put out. Okay? And then, so they have to do some roof work. The seller's giving them a credit of $120. They got to redo the cooling tower. They're getting a credit of $230. Okay? They got to do some additional TI that they're going to get a credit for. So, what I would tell you is this: it's a supply and demand issue. The more offers you have, the less that the seller has to negotiate with people. Right? I can tell you this. You guys saw the volumes that I shared with you during the capital markets class on institutional real estate transactions. I'm not going to go through some of the, or in detail some of the current news that's going on, but just CalPERS last week announced that they were going to add another, it was like $26 billion to their real estate portfolio, That's additional money coming into the space. So what typically happens is the last few years, other than the window of 2008 to 2011, they've been seller's markets. So, so the roof needs a little bit. Okay, well, just, lower your return expectation. It's not coming out of my pocket. Now, to the extent that it's, more of a buyer's market, then you'll see people negotiating with that. Or in a situation like this where, like I said, okay, we'll get back $500,000 because it's not material to us. They're going to have to come up with $1 million. We'll give them half of it. Okay? Make sense? Okay. So as I said, I'm not going to read the articles, just, I always like to bring stuff that's happening. I thought this was really interesting. Amazon is opening, for those of you who didn't see it, Amazon is opening a store on 34th Street in New York. So they kind of gone from, it's kind of going the other way. So there was a term I heard, omni-channel. They are an omni-channel business, okay? So it's kind of funny, they've taken, what do we figure out, it was like $100 billion worth of revenues out of retailers. Now they're opening up a store, which I think it's only for delivery now, but.
Professor, something about Amazon, the price to earning ratio on Amazon is crazy high, right? Or am I mistaken? Are you familiar with the price to earning ratio of Amazon?
No, I'm not. I think you're right, but that's not the kind of profile company I look at. But yeah, I think it is relatively high. Why?
Because they comment, I mean, they told me that it was just so crazy high that they don't see a point, they don't know how it's gonna get to the point where it's just gonna be low, like a stable company like GE or.
Well, just for those of you who didn't take the capital markets class, just the only point related to that, and I won't spend a lot of time, is companies that have high growth rates associated with them typically can compel a higher price to earnings ratio, because the expectation is that the earnings are going to increase very rapidly, right? So, the real question I think people ask with Amazon is, if you're selling $100 billion a year already, how much more growth can you have? And with the margins that they have, increase the margins to a point that's going to be, substantial to, or significant to the earnings. So, yeah, it's not the kind of company I would buy. But, CalPERS reboots, I mentioned that. So they're going to boost their real estate investments by $7 billion. So to $26 billion. So $7 billion, fresh allocation to commercial real estate. That's just one investor. I'm going to leave this one for a second, and I'm not going to spend time on it. So,
CalPERS was the same one that took all the money from the hedge fund? Or would?
they were reallocating their alternative. Some months ago, they were pulling stuff out of hedge funds, and so I guess some hedge funds have underperformed, right? Because well, up until last week anyway, because the markets just haven't been reacting the way a lot of professionals expected, and so I guess they figure real estate is more stable and better suited to their liability requirements. Which I printed this one. There's a reason I printed this one. I don't know if it's about senior housing, but maybe it's I'm getting old. I don't remember why I printed it. I got it.
Trying to find a residence?
Maybe that's why. Oh, here's the MetLife building, the one I was mentioning before that grew like by 10%.
It's the airspace.
Manhattan office leasing heats up. Vacancy rates decline and overall asking rents rise in the third quarter. So overall rents in New York are now being quoted at essentially $65 a square foot. So again, if we work back on cap rates, a cap rate of 5%, what does that translate to in sales value? Come on, put out a calculator. Was that $1,200 a square foot? How does that contrast to Florida suburban? It's like 5 times as expensive, right? Something like that. You don't have to do it, but just that's how you can draw the comparisons and the relationships, right? If you want to know how much a building is worth. Now, so I'm not going to spend any time other than saying this, because I know a lot of us in this class and a lot of us in South Florida like to speculate on residential real estate development or residential real estate. So, article in the New York Times this week, and this is from Robert Schiller. You guys probably heard Professor Schiller from Yale, and he does a case in Schiller, whatever, and then there's a whole futures index, traded on that. He also gathers a bunch of historical, stock data and all that. But the point is, from 1890 to 2014, after inflation, what has been the average annual return on residential real estate in this country?
6%.
6%. So assuming I'm going to give you an assumption, assuming that inflation is 3% a year on average. So you would say that without adjusting to inflation, residential real estate has returned 9% over the last 115 years in this country, 125 years. Is that correct?
I'd say.
Okay, let's try door number 2. That's door number 1. Let's try door number 2. You said it was low, so
6.5. 6.5.
well, so 6.5, so it would be 9.5%.
Oh, I'm sorry, 3. 3 after inflation.
Oh, 3.5. So you're saying it's the other way around. So,
Right.
so we're saying 6 here, and forget inflation for a second. 3.5. And do we have a door number 3? Do we have anybody that thinks it's higher than 6%?
12%.
12%. So I'm not gonna go through the math, but since you got your calculator, you could do it when you go to the restroom or something on your break. And you can tell us if you bought a house for $1,000 in 1890, what it would be worth today at 12% annual return on top of inflation. I would best bet it's probably not that, but 0.5%.
What is it?
0.5%. 0.5. So all the speculation you see here in South Florida, all the real estate investor wannabes that are focusing on residential, you're in the wrong business. That's what history says, you're in the wrong business. So, as with speculation, there are times where you can make a lot of money, and there are times that you could lose a lot of money. So, okay, that's what's important to read all this stuff, guys, you know, because it validates. Remember, one of the things that I wanted to bring across in the capital markets class was when we believe things, right, we should either validate them or dispel them. Should validate them or dispel them. Okay. Alyssa, you're working for Jones Lang LaSalle now,
Yeah.
accumulating market statistics, market data?
Yeah, I just started about a week ago.
Well, I'm probably reading your report. So,
I don't think they've made their way to you
they're
yet.
not, okay, well, I got, so, we're poor college students, right? I mean, some of us, who's got access to CoStar at work? Hello, yes, okay, she's got, does anybody else have access to CoStar?
I do.
Couple people. A little bit, okay. Who's got Reese? You got Reese. Anybody got money to pay for Reese? No. Who's got Real Capital Analytics? Well, that's not leasing data. Who's got Real? I got that one. Green Street, anybody track Reese? Green Street, nobody? Okay, so the problem with, Glenn started talking about, you know, data before, right? He started talking about Reese, CoStar. Information is costly. Gathering information is costly, and there's businesses out there that charge a lot of money because it costs them money to accumulate market data or information that people want to buy. So if we're a real estate professional and we want information, we may need a lot of money. Or we may need to have friends. Or if we're struggling college students and we got a project to do in an hour, what do? We go online and find people like Alyssa that give us information for free. So I'm going to show you how I get my hands around the office market in this country. Hopefully at this point, we learn a little bit about the office market also, right? Because we should know a little bit about all the different markets that we participate in, right? So how big is the office market in this country? Any idea? Any idea? How many square feet?
2 billion.
2 billion, okay, it's a good number. Any other billions? Any other doors? 3 billion? Come on, you put this together.
Square foot?
Square feet. You can do it in square meters, we'll multiply by 11. Okay, roughly 4 billion square feet. Roughly 4 billion square feet. Now, for those of us who took the capital markets class, I told you typically we talk about two different sort of subclasses of that, right? We talk about CBD, central business districts, buildings that tend to have certain characteristics, and we talk about suburban, which also, not only by location, right? Because by definition, central business district buildings are in downtowns, suburban tend to be outside downtown, but they also tend to have different characteristics, right? Different amenities that are offered, different operating cost structures, different costs associated, different rent structures associated with them, different cap rates, different risks, right? Different tenants, different credit profiles, etc., right? So it's important to understand those. You know roughly how much of the 4 billion square feet are suburban and how much are CBD? Any idea?
60-40.
Okay, 60-40, so 60 what?
60 CBD.
Central business district, 40% suburban.
I think it's
60 central business district, 30% suburban. 40%.
20/80.
Okay.
80 suburban.
Okay, that's I would bet more suburban. So
Because of how it's set up, spread out?
60 suburban roughly, 63% suburban, 37% CBD. Which are the largest markets in this country? Which are the largest office markets in this country?
New York,
New York?
New York,
San Francisco, Miami.
LA?
Miami.
Miami.
Chicago.
Okay, so I heard New York, I like that one. Chicago, I like that one.
Boston?
Houston. Boston, LA, DC. Okay, why DC?
Because that's where all of the.
So that's where all of our money goes. In 2010, when I looked at this report, I used to go over these things in the accounting class. Don't ask me why in accounting, but I used to go over this in the accounting class. The only city in America that had office construction going on was Washington, D.C. Because it's our money. You know, they're always building stuff in DC. No, it's a large business center because of all the business surrounding the government. So, curiously, New York, New Jersey. So, New York and metropolitan New Jersey, Newark, you know. 24% of the office market in this country is concentrated essentially in those two markets.
Wow.
If you add Chicago and LA, that's 35%. Houston is an important one, but it's not quite as important as those other ones. Philly is an important one. Boston is an important one. Here's a curious one. Claudia talked about the crazy development going on in Houston, right? So one of the things I'd like to look at is how much new product is coming online, right? As I said, 3 years ago, there was like no new office being built in this country other than in Washington, D.C. Today, there are 71 million square feet under construction in this country of office space. So why do I care about that? Well, I care about that because if I own assets or I'm developing assets or I'm thinking about buying assets in a market, I want to know how much additional supply is coming in line. Now, curiously, that's only 2% of the total supply. So macroeconomically, 71 million square feet doesn't do a whole lot. In fact, if you absorb more than that every year, that's still good to be an owner, right? Absorption, year-to-date absorption is 38 million square feet through the third quarter. Okay, so you know, you're absorbing about half of the new construction, so that's not good overall, even though you're not adding a lot of supply. Remember things we talked about in the cap markets class? And there's no answer, but the question is the way we're working and the way we're living supporting the underlying economics of the office market, right? You were challenged when you did that project. I remembered, I know who did what in all of my classes. You were challenged with what are the size of the markets, right? If we say that hoteling and commuting, telecommuting and smaller offices and all that really do have an impact, what's the size of the office market today and what was it, 10 years ago? What are the trends? I'm not asking you to answer that now. That was part of the hieroglyphics that I wrote, you know. But Houston is an office market with 155 million square feet. But today there are 15 million square feet being built in Houston under construction. 10% supply is being added to the market. Now, I use this example in Miami. The problem, especially in CBD with buildings, is you can't build a 125,000 square foot building, can you? The economics don't make sense in the CBD. So what do you got to build? A 1 million square foot tower, right? 1 million square feet is like a tremendous amount of supply to absorb. Now, there must be 15 high-rise. You're from Texas. I know it's another part of Texas, but that's crazy. Like, I would not want to own an office building in Houston. Because when I look at the stuff, vacancy's 15%, which is, what's overall vacancy in this country in office? What should it be?
8%.
Office, man, we're not talking industrial, we're talking office here. 16%. Do you look at my notes? 15.9%. Now, is that different between CBD and suburban, Dylan? Let's go. I'm not even going to look at my notes.
Yeah,
Oh, okay. How so?
I would say CBD is less occupied, more vacancy.
You think CBDs have more vacancy
No.
than suburban?
Not anymore.
I would say.
No, it's the other way around, typically. It's not macro, so all markets are different. But macro, it's about 14% CBD vacancy and about 19% in suburbs, 18% in the suburbs, okay? What are average rents in this country for office? We should, you know, if you gotta, your boss says, hey, we gotta go rent an office, what's it gonna cost?
Where are we?
Fort Lauderdale,
About $25 if you're in the CBD.
$25.
22 actually in Fort Lauderdale.
CBD?
Mhm.
Show me where, I'll go sign a lease for the sublease space. I think it's probably a little bit more, I don't know this market that well, but I'll tell you in a second, I think it's a little bit.
32. 32.
It's in the 30s, I would say. But anyway, so overall in this country,
Just one,
Yeah.
actually, the building that they're building, apparently just down the street here on the corner of Los Olas, Styles did a presentation on this past week. Supposedly, the first floor of that is gonna be leased at something like $60 a square foot.
I would guess, and I got it, I looked in Miami, that's why, and I don't live here, so my guess would be that CBD Broward on average is probably close to $40. I would say it's in the 30s. Asking gross. And is there any retail in that or no?
The first floor, there's potential.
Some potential summary, but still, it's $60.
Roughly.
Okay. Now, how big are the markets in, out of 4 billion, how much is South Florida? How important are we? Are we the elephant or are we the gnat on his back? Okay, so we're the gnat. How big, if New York is 25% with DC, how much are we? 2%. 2%.
South Florida.
South Florida, okay? And that's Miami, Fort Lauderdale, and West Palm combined, okay?
No jobs here.
I'm sorry?
No jobs here, right?
Well,
That's not true.
it's not that there's no jobs, you know, we're a service economy primarily, right? You start going, you know, look at the asset. We're service economy primarily, there's a lot of retail down here, right? There are a lot of entertainment type spaces that maybe you don't find in other places. Also, you know, theaters, golf courses. I mean, these are all real estate businesses in one shape or another. You know, I'm sure in Wisconsin they don't have a lot of like golf courses. Maybe they do, I don't know. Transient people down here, a lot of self-storage, very vibrant self-storage business down here. I don't know if that's the case in other parts of the country, okay? What are CBD office market rents versus suburban office market rents? Yeah, they're higher in the CBD. I mean, part of it is because the expenses are higher to operate. What?
Land costs more in CBDs.
Well, so does the construction typically, right? You know, high rise, you know. So, what are the typical operating expenses in an office building? Give me a dollar amount. Suburban or CBD?
That was your suburban example up there.
Okay, yeah, good memory, right? So $10. So in Florida, 10 to 12 bucks for a suburban building is probably not a bad guess. CBD would be more or less.
More.
Because typically there are more services, right? So, how much more?
17 to 25.
Well, no, maybe not 25, but you know, 15, 17, 18, you know, it depends on the level of security and utilities you're providing and you know, the concierge and all that kind of stuff, okay? So, how big is the office market in Florida? So if it's 4 billion and we're 2%, we're not even quite 2%, right? Well, I use South Florida, I'm sorry. I was using South Florida for that. So how big is the office market in Florida globally, not South Florida, globally? It's 160 million square feet in the 5 major metros, right? And I say 5, we've got Miami, Fort Lauderdale, and West Palm, which you could call 1 or 2, right? I should say 6, because then we've got, where else do people live in Florida? Orlando, Tampa, and Jacksonville. Nobody lives anywhere else, okay? No, that's just like mobile homes and things like that.
Oh, good.
No, I'm just kidding. Okay, and which is the biggest market? Which is the biggest market down here? How big?
What's
22%, almost a quarter of the offices in Miami. And the smallest one would be which one?
Check.
Jacksonville,
Oh, I hope.
by far. There, his home, he knows that, okay? So, you didn't say that, but if office rents in general are $30 in the country, they are roughly, and remember the proportion of 63, 57, or 37, 63, 50, 53, 37, 63, right? They're roughly $40 a square foot asking for CBD, and $26 for suburban, okay? In Florida, the rents are all over the place. Rents range from $18 in Jacksonville to in the 30s in Miami and Fort Lauderdale, okay? Occupancy here is not radically different than it is in the country. The split between suburban and one second, between suburban and CBD are not radically different either. Yes, Nicola?
That 40 and 26 you just gave, where was that for? Because I thought that was Florida, but then I heard you making it.
No. So, I'm sorry, I said two different things. I said, oh, that's national average. Those are national averages. I'm sorry, those are national averages. Okay. But then you keep honing in and you say, why am I doing all this stuff? Because you guys are going to do the same thing right now. Okay? So I did this in my office the other day preparing for this, okay? So I found this. I said, let's look at Miami. Miami, we talked about Miami's 35 million square feet, right? Which are the major markets in Miami? We've got CBD and suburban, right? What's the CBD market in Miami? Are there any sub-markets in the CBD? Yeah, asset class, what are they?
Brickell.
And downtown, right? So, in Fort Lauderdale, you would only have one CBD market, which is what we're sitting in right now, right? So, you start honing in, you start going in, and you start saying that the suburban office market in Miami-Dade County is 22 million square feet, in suburbs, 14 million square feet in downtown. Rents are $37 a square foot in the CBD, $29 in the suburbs. And again, these are gross asking rents. Deals may get done a little bit less. Maybe some deals get done more. There's extra TI thrown into the deals or whatever. And every building is different because of the operating expenses as well. Remember, these are averages, okay? Brickell and downtown are approximately the same size. There is significantly greater vacancy in downtown Miami. It's about 20%. That's high. When was the last office building built in downtown Miami? Do you know? Does anybody remember? Who's from down here?
They built the federal courthouse, so that's not really.
Well, but for lease, when was the last building built in downtown Miami? Office building. Can't even remember, can you? Well, there was one built 3 years ago, or delivered 3 years ago by MDM, which is where Deloitte and Greenberg are, right across from the Hyatt, which is 600,000 square feet. It's called the Wells Fargo building now. Before that, it had been since 1987. And vacancy is still at 20%. So it's probably not a market that sees a lot of growth or has a lot of future. Now, curiously, the 2 or 3 buildings that do trade there, the first, it went back to the Southeast Financial Center, which is what its original name was. The biggest one, the biggest one in the downtown, where Wachovia used to be in First Union. That thing traded for $500 a square foot 4 years ago, and bless you, in horrible market. So the trophy assets, even in not great markets, tend to trade very highly. Okay, rent's $37, and so Brickell rents are higher, vacancy is lower. In downtown, rents are lower, vacancy is higher. Supply and demand, right? Pretty simple, right? There are several submarkets of offices in Miami. The 2 largest ones are Coral Gables, which has its own little CBD, which is home to a lot of international multinational headquarters. And why are they there? Proximity to the airport, proximity to residential areas with schools, so executives like to be in that area, okay? A lot of amenities, hotels in the area, restaurants, etc. And then the other one is
West.
Dade County. I'm doing Dade, I'm not doing Broward because I'm more comfortable there, but you guys can do that in a second. It's called it's Airport West or Doral, whichever you look at. And again, proximity to the airport, services, and they're not so much to residences, but transportation. You've got the turnpike and 836, it could take, or 826, it could take people north-south, and 836, it could take people east-west, okay? So now you start seeing the drivers that drive offices, right? Services, transportation, right? Those two submarkets are really it. Everything else is a whole bunch of little submarkets. CoStar gives us a whole bunch of stuff. The office market in South Florida was booming in the 1980s. We had years with as much as 12 million square feet of deliveries in a single year. 1984, 1985, 1986, there were 25 million square feet of offices delivered in South Florida. Now you contrast that to the last 3 years where we've had 1 million square feet delivered. What does that tell you? Is there any growth here? You know, you were asking me, Mark called the other day, we were just exchanging ideas, and one of the things we talked about was the company I worked for. We built, I forget the number now, 10, 12 million square feet of industrial and office over, you know, a 10-year period or something in late 90s to the early 2000s. We barely developed anything the last 5 years I worked there. I don't think they've really done anything since I've left. So we've had huge growth spurts in the region, but growth has been really very temporary since then. Yes, Michael?
Was that in like the 80s, the accelerated depreciation?
Yeah,
Looking
so-
back at that, was that a bad thing, or was it just, it needed to be done?
Were you in Texas in those years?
Absolutely.
So there was, so Reagan was elected in 1984?
Well,
80, right, 80. And you know, we've talked about the whole stagflation and all that, right, 80.
Yeah.
So
Everything was great until the Tax Reform Act of '86.
that's right. So what happened, but there were incentives
Right.
that fueled,
Yes.
so some of the incentives that came along with the Clinton guys were like the Larry Kudlows of the world, right? You know, all the, you know, incentives and stimulus is this? Stimulus was, I remember, because we used to do this stuff, you get like investment tax credits of 10% on like real estate investment. So, like I worked at Price Waterhouse, we had guys that would go to a building and then they would like separate, like the carpet would qualify for ITC, right? And like the light bulbs and the little metal things. And so they were experts on what qualified. And so you more than paid for your services. So a guy would develop something and get like a 10% tax credit. And there were all kinds of accelerated depreciations. And correct me if I'm wrong, I think one of the single biggest issues was that you could depreciate, these tax shelters existed where you could depreciate, you could have losses
Ridiculous.
and write it off. And you know, ultimately they came up with these hobby rules. You gotta make money.
Yeah.
If in 3 years you don't make money, it's a hobby. It's like if you own a horse,
Oh, wow.
if he doesn't make money after 3 years, he's a hobby. And you can't deduct losses from a hobby. Okay? And that's not exactly the same thing. But the Tax Reform Act of '86 came in and said, hey, this thing's out of control. There are a whole bunch of other things happening. Vernon Savings and Loan, you
I
remember?
mean, you know, real briefly, I mean, it's just the whole thing that real estate was being built for all the wrong reasons. It wasn't being built because of supply and demand. It was being built by artificial stimuli brought on by the tax code. And I mean, you know, fundamentally, I mean, you can look at a pro forma and say it doesn't make any sense because the rents aren't there, the occupancy's not there, yet it made perfect sense to investors that obviously have a lot of money they put into shelter.
And that shelter, what allowed is, so you could have money in the bank earning X, right? Or being impacted by high inflation, or you could buy real estate, right? And depreciate the heck out of it under very accelerated methods. And because you had other income, so you still had this hard asset here, and it was generating tax losses for you. So basically, the Tax Reform Act of '86 closed a bunch of these loopholes, and all of a sudden, like, real estate went like,
Well, along with the oil industry.
yeah, the oil industry, but there was another issue too, which is banks, S&Ls, became joint venture, and there was a lot of,
Interplay.
yeah, they became investors, you know, they started participating in the equity, you know, in the upside of real estate development, providing the capital. There were a lot of people that wound up in jail, the Charles Keatings of the world, the Don Dixons, all these other guys, so, yeah, that was all artificial.
Right.
But, you know, the point, but why do I bring this up? Because supply is important to the supply-demand paradigm, right? So, I don't know the answer. I didn't even try to address here what the implications of all that are if you live in South Florida or if you want to participate in the office class, right? But the real question to take back or the understanding you need to take back with you at any given point in time is you need to understand what the supply drivers are, because I've shown you, and I've continued to mention here, there is a direct correlation between supply and demand, between demand and rents, and between supply and rents. And so, you can take it to the bank. The higher the occupancy, the higher the rents. The lower the occupancy, the lower the rents, okay? And they don't tend to move, they tend to sort of like, you know, all of a sudden people see it down, boom, rents go way down. I got this information from Jones Lang LaSalle, but, you know, you could go to Newmart, you could go to Marcus Millichap, you go to CD Richard Ellis, you could go to the Cushman Wakefield site, you go to places like Integra, you can go to any one of these real estate, you can go to HFF and get office updates, you can go to any one of these guys and get information, okay?
Are these for a fee or?
It's all free. I just downloaded all this stuff. So, I thought that as a nice, you know, sort of exercise, since we have computers, and we haven't used computers since I've been teaching here, right? I was going to break you guys into groups and give you an hour to do a little bit of digging. Ooh. Ooh. So, I already decided what groups to break you up into, okay? Hello? Hello? So here's what I wanted to do. Okay, here's what I wanted to do. You've got till 4 o'clock, 4:05. Dustin, Daryl, Michael, and Robert, you guys get together. I'll give you the passwords if you don't remember them, okay? Get together. Now what I want you guys to do is find, and report back to the class in 5 minutes what the multifamily market looks like in Miami-Dade County. So, you asked a very good question before. If I've been quoting rents to you on a per square foot basis, are you going to quote those rents on a per square foot basis for multifamily? Maybe, maybe not. I'll let you take a look at the information that's available, okay? And so I want you guys to gather your notes and be ready to stand up here in a moment's notice, okay? And give us a 5-minute overview. So everybody in the class knows about multifamily in South Florida. But before you mobilize, let me tell the other groups. Mark, Mariel, Frederick, and Dylan, I want you guys to take a look at the industrial market in Dade County. Alex, I want you to get with Tyler and with Johnny, and I want you to take a look at retail in Broward.